I've then used these rates to plot a mortgage spread. This is the difference between the yield on the 5-year government bond and the 5-year mortgage rate. And we can see that spread coming down. So historically, a low and sustained fall in the mortgage spread has meant real growth in the UK housing market and indeed then prices. Okay, from here we've got three key leading indicators left. We're going to take a look at the RICS supply and demand metric, the GfK sentiment index, and then take a glance at the implied inflation forward curve. But before we do any of that, I've pulled out the last 20 years of sold price data for June. So what can we expect then in terms of sold prices in the month of June? Well, historically, that doesn't predict the future. Okay, they say the history rhymes, but it doesn't repeat itself. But nonetheless, we can use this to extrapolate forward and say, well, statistically speaking, with only one down month in the last 22 years, that of course being 2008, we can therefore expect a positive month-on-month move for the month of June. However, in the same way that bookmakers lay odds on the favourite, that doesn't mean that the favourite cannot lose. If we see a move to the downside in June, it will be more statistically significant than a positive month-on-month move. It's one to watch out for. The truth is, we can't look at the UK housing market and discuss a potential house price crash without looking at supply and demand, basically economics 101. But why it's so crucial was the reason we had the market we did last year. Very low supply, very high demand, which sent prices up. But as we discussed early on in this video series, we could see data showing the unwind of this and actually a reversal, meaning prices would adjust too. Or that was our bias driven by the data. So what we have here is a homegrown supply and demand metric where we have new bar inquiries in blue as an expression of demand and timely demand, and new vendor instructions as an expression of timely supply in red. So I trawled back through the reports, the RICS reports, and dug this out and used it to create a spread. The spread is just simply the difference between the two, because we only want to talk about supply in relation to demand and vice versa, demand in relation to supply. That will give us the whole picture. Well, the latest reading is firmly negative, rising supply and falling demand. So the spread is falling. This, I feel, is negative for the housing market. Now, I've carefully chosen my words there, but here's the backstop, or here's the backstory or the small print to go along with that. The market does not care what I think. I see people in the comments asking me, what do you think about X? What do you think about Y? My response has to be, as it has been from the start, the market doesn't care. I'll explain why. Let's say I take all of this data, I create a bias, and I want to go and express that view in the market, either buying, holding and waiting out for better price action, or perhaps selling something. I am one person feeding the market one data point. It's receiving hundreds, if not thousands, every day. So the market does not care what I think, therefore you should not care what I think. I've said this from the start and I maintain it still. I'm not a YouTuber, I have nothing to sell you. This is the data, I can present it to you. You tell me, and I'm genuinely interested what you think is going to happen. So then just to recap, the supply and demand metric fully inverted. And I have just a couple of quick graphs that I've nabbed that actually highlight this. Now I have a really rough and ready way, it's pretty accurate, of calculating the total number of listings, that giving me basically supply on Rightmove, and compared to last year it's up 65 to 75%, meaning supply has dramatically increased. And what we can see here is a metric from Rightmove, the average time to secure a buyer. So last April it was 31 days, this April this year it's 55. So we're seeing increased supply, we're seeing from RICS lower demand, and we're seeing that play through as the average time to secure a buyer is up dramatically. Fair enough, you might say. But I can go one step further. If we take a look at the monthly number of reductions on Rightmove, we can see that the April data has jumped enormously when compared to April of 2022. So the time taken to sell a property is up, the number of listings are also up, and that's brought the number of reductions up as well. The market is beginning to slow. Now, I said at the start of the video we're going to unpack some Rightmove stuff, and we're going to do that after looking at sentiment index from GfK. We're going to look at some yield curves, and then we're going to come back and unpack that Rightmove number. So here we have the GfK UK Consumer Confidence Measure. It's an overall metric which comprises of questions like, what do you think the personal financial situation over the last 12 months was? Score that. Same again, but over the coming 12 months. A general economic situation again over the last 12 months, and general economic situation over the coming 12 months. Major purchase index and a saving index. Well, the headline score here in orange is for May is minus 27, up actually from minus 36 in March, and year on year up from minus 40 in May of 2022. So things have improved steadily. However, we're still down at those 2008 confidence levels from around the GFC. So although things have improved, I would hardly say they look massively optimistic. And now we've jumped over to the UK instantaneous implied inflation forward curve. So the Bank of England is quite clear. The reason they are having to hike rates is to combat inflation. And of course, as we know, mortgage rates are priced off that future interest rate expectation. Mortgage rates, as we said, feed into affordability and, of course, the amount you are able to borrow, which in turn reflects through into house prices themselves. So if we can get ahead and look at the market curve, then we might be able to see what's in store for inflation in the coming months ahead. And for anybody interested, just below that's the UK instantaneous nominal forward curve for overnight index swaps. And we've got the 5-year swap rate pushing on 5%, which is pretty much almost back to where we were in the Liz Trust days. So we said we were going to talk Rightmove, so we're going to jump back into the spreadsheet now and do just that. So we've had this tab here, the very first one, RM versus LR, since the very early beginning of these videos, so that we haven't been in there for a bit, so let's jump in and see what's cooking. So to recap then, we had May figures, the Rightmove May figures showing asking prices up 1.8%, giving annual year-over-year change of 1.5%. And we said if that left you scratching your head, you're not alone. So here we are about to unpack that. And what we were posing was, what's the difference between asking prices and actual sold prices, right? Because nearly everything is on Rightmove. It's got huge market coverage, I think around 97%. But it doesn't really matter what the ask is, what's the bid, doesn't matter what the asking price is, what's the sold price, that's what matters. So how does this look historically if we back that data out? And then what we're going to look at is that in various ways. What's the difference in percentage terms, and can that tell us anything over a historical context? Well, first up, let's look at the difference, or let's just plot them here, as shown in this first graph, with Rightmove asking prices shown in blue and land registry sold prices shown in red. And we can go ahead and plot that difference in sterling terms in this graph, one here below. So you can see around 2008, it was around 40 or 50, 48,000 there, look, in February of 2008, the difference between the two. And obviously since 2000, so since the blow up, since GFC, we've seen that spread getting wider and wider, with the difference around here being around 86,000 in 2016, where it's kind of hovered flat ever since, getting near that stage, or actually to that stage, in May of 2022, so last year. So the difference between asking prices and sold prices is up when compared to, say, 2004, 5 to 8. Well, of course, you'd expect that because this is in sterling, and we've seen house prices since then go up. So we should really only talk about this in terms of percentage, or the percentage difference between Rightmove and the sold prices. And here in this graph, I've done just that. Here is the percentage difference between asking prices and sold prices. So let's unpack this a little bit on a larger scale. Okay, so what are we looking at here? Well, as explained, it's the percentage difference between asking prices and sold prices. But the first thing to note is Rightmove asking prices are for new properties being listed. So it's an optimistic measure and one that does not include revisions in prices downwards. Okay, so let's run through this because we can see from here to here, this period here to this period here, if you're looking at the corresponding dates, is where we saw very, very high house price inflation, culminating in the peak here. But as you'll see on the axis, it's inverted, meaning the gap between the ask and the sold price got really, really tight before it went pop at around 17–18%. We then see the unwind and prices fall, and as this is happening, the spread or the difference is widening too, maxing out here at around 30% in May of 2014. Now, does this look familiar? Well, it should do, as it follows the exact same path as real wages. The correlation here is undeniable. So no surprise to us then, after we see real wages start to pick up, we then start to see this spread tighten again and sold prices ever so closer to the asking price, because you can achieve tighter sold prices when price momentum is positive, and that makes sense. We now come on to where we are today, or in fact where we were in December of last year, where lo and behold we hit the same levels as you've guessed it, right before the 2008 GFC. So what are we actually saying then? Because we're seeing falling sold prices now 4 months in a row, but flat or increasing asking prices. Well, if this goes this way and goes down, which means the gap is widening, we will likely see flat or still even increasing asking prices, but lower sold prices. And that happened simply as we saw in 2008. So bizarrely, in a falling market, we could see some strange asking price numbers. But in fact, you could say it's not strange at all. It's all very orderly, and rising prices will bring about lower sold prices. But just to show you some of that orderly buying psychology or cycle behavior, check out these peaks here. So we can see December and August. We see December and August, December and August, December, August, etc., etc. Pretty much all the way through this. So if that doesn't clearly show you when a good and bad time is to both buy and sell, I don't know what does. Let me lastly just put a widening spread or the gap between sold prices and the asking prices increasing in an example. Let's take an asking price of £100,000 and sold prices at say 80,000, which is as close as we can get to this gap that we're seeing here at around 18%. We're just using 20% here for round numbers. So what we're saying could happen is that sold price moved down from a 20% difference to a 30% difference, i.e. from 80,000 to 70,000. Now, all the while asking prices remain at that £100,000 level. So that's how we could see flat or increasing asking prices, but still seeing continual falls in sold prices. So in conclusion, mortgage approvals are down off top, but showing 2 month-on-month increases, but nothing we haven't seen before, as shown in this graph here. Average weekly earnings have in fact fallen, but not by that much, and the rate of change seems to have stabilised. In fact, only falling £1 from January 23 to March 23 versus falling £9 from January 22 to March 22. M4 growth continues to push lower, real M4 growth that is, like every other house price crash. Rates in April were falling, but swaps push higher on that inflation miss, and of course swaps price fixed rate mortgages. In terms of supply and demand, average days to sell are up, so it's harder, it's taking much longer to sell a property, and it's much more difficult because supply has also increased and so are reductions. So just a note on that right move index, it's derived from the initial price that a property is put onto Rightmove. So agents essentially trying their luck and then having to reduce the property price in the future. And of course, with that inflation miss, further hikes are being priced in for the Bank of England. So there you have it. Short term, things looking a little bit flat or a bit of a mixed bag. However, year over year, we can see massive, massive movements in all indices. And of course, we'll pick this up in a couple of weeks, in a few weeks, with some fresh data. So thank you so much for watching, and I'll hopefully see you in the next one.